Today, inflation is hot, hot, hot. Hello again, it's Martin North from Digital Finance Analytics, where I've noticed posts covering finance and property news with a distinctively Australian flavour. Well, the Consumer Price Index came out today and it rose 2.1% in the March 2022 quarter and 5.1% annually, according to the latest data from the ABS. Annual CPI inflation at 5.1%, lifted due to higher dwelling construction costs and automotive prices. The ABS said the CPI recorded its largest quarterly and annual rises since the introduction of the goods and services tax. The trimmed mean annual inflation, which excludes large price rises and falls, increased 3.7%. That's the highest since March 2009, and guess what? Well above the RBA 2 to 3% target range. Most significantly, though, non-discretionary annual inflation was higher than the CPI and more than twice the rate of discretionary inflation. Non-discretionary inflation includes goods and services that households are less likely to reduce their consumption of, such as food, automotive fuel, housing and health costs, which all have experienced price rises through the year. In the quarter, non-discretionary inflation grew by 3%. That was driven by housing, automotive fuels and food. That's 6.6% for the year. So sure, most people are feeling a much higher inflation rate than the massaged average rates. The most significant contributors to the rise in the March quarter were new dwellings up 5.7%, automotive fuel up 11%, and tertiary education up 6.3%. Continued shortages of building supplies and labour, heightened freight costs, and ongoing strong demand contributed to price rises for newly built dwellings. Fewer grant payments made this quarter from the federal government's Home Builder program, and similar state-based housing construction programs also contributed to the rise. Or in other words, their messing with the building and construction sector over the last couple of years has now yielded a high inflation number. And of course, rents in Sydney and Melbourne recorded small rises in the March quarter, but rents across the remaining capital cities continue to record relatively stronger rises, reflecting historically low vacancy rates. The positive growth in rents for Sydney and Melbourne was mainly driven by rising rents for houses, while other dwellings recorded a relatively smaller rise in Sydney and a small fall in Melbourne. So once again, it underscores, if you're holding an apartment, particularly a high-rise apartment in Sydney and Melbourne, don't expect an increase in rental returns. Rental conditions for other dwellings remain subdued in Melbourne, reflecting higher vacancy rates. Rents for both houses and other dwellings increased at a similar rate in the remaining capital cities. The CPI's automotive fuel series reached a record level for the third consecutive quarter, with fuel price rises seen across all 3 months of the March quarter. Automotive fuel prices rose for the seventh consecutive quarter, resulting in the strongest annual rise since the Iraqi invasion of Kuwait in 1990. The automotive fuel series reached a record level in the March quarter due to an oil price shock caused by the Russian invasion of Ukraine, paired with ongoing easing of COVID-19 restrictions, which strengthened global demand. The national quarterly average price for unleaded petrol increased to $1.83 per litre in the March quarter. And the rise in tertiary education reflected the continuing impact of updated student contribution bands and fees, which were introduced last year. Notable rises were also recorded across the food groups, up 2.8%, reflecting high transport, fertiliser, packaging and ingredient costs, as well as COVID-related disruptions and herd restocking due to favourable weather. Main contributors to the rise in food prices include vegetables up 6.6%, waters, soft drinks and juices up 5.6%, fruit up 4.9%, and beef up 7.6%. The rise for the food group was softened by voucher programs in Sydney and Melbourne, which reduced out-of-pocket costs for meals out and takeaway foods. The grocery component of the group, which excludes meals out and takeaways, rose 4% in the March quarter, the ABS said. And prices for other grocery items, such as non-durable household products, were up 6.7%, which includes products like toilet paper and paper towels. Annually, the CPI rose 5.1%, with new dwellings up 13.7% and automotive fuels up 35.1%. They were the most significant contributors. Strong demand combined with material and labour supply disruptions throughout the year result in the highest annual inflation for new dwellings since the introduction of the GST. Annual price inflation for automotive fuel was the highest since the 1990 invasion of Kuwait, the ABS said. The price of goods were up 6.6%, and that rose more strongly through the year than services, which were up 3%. And underlying inflation measures, which reduce the impact of irregular or temporary price changes to the CPI, showed that the quarterly trimmed mean inflation increased to 1.4%. That's the strongest movement since the beginning of the series in 2002. And annual trimmed mean inflation increased to 3.7%, up from 2.6% in the December quarter. Annual trimmed mean inflation was the highest since 2009, and that reflects the broad-based nature of price rises as the impacts of supply disruptions, rising shipping costs, and other global and domestic inflationary factors flowed through the economy. Finally, inflation did vary across the main centres, with the average of 5.1% masking a significant 7.6% rise in Perth for the last year, a 6% rise in Brisbane, 5.8% rise in Hobart, 5.5% in Darwin, 5.4% in Canberra, 4.7% in Adelaide, 4.5% in Melbourne and 4.4% in Sydney. So there you have it. Inflation is roaring ahead here in Australia. And of course, the true experience lived by most households is closer to at least 6%, probably even higher, because of course there are various foibles in the way the numbers work. So the question is, should the Reserve Bank then lift interest rates? Well, given the broad range of inflation, they almost will be forced to lift rates. It's only a question of whether it's May or whether it's June. But of course, below the waterline, there are already signs of slowing. So I have a theory that we will see rates go up and then they will come back down again. But the real question is whether these inflationary pressures really are going to dissipate or whether we will continue to see stronger inflation ahead. Because, of course, the stronger inflation is, the more the RBA is going to have to lift rates. And that's going to have a very profound impact on the broader economy and indeed could lead to a recession or worse. I'm Martin North from Digital Finance Analytics. Many thanks for watching, and I'll see you again next time.